Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's go back into the software. Give me a second while I go ahead and switch back in. And let me know when you can see First Trust, ISE, natural gas. You should be able to see that again.
See perfectly clearly, Jeff. Thanks.
Good. Okay. Now, because I promised Chris, I'm going to show you how to apply this in your MetaStock program at home. All you do is you open up the security that you're interested in seeing. And what you're going to do is you're going to right-click on the chart, go to Apply Template here, and you'll find the one that's called RMO Trade Model. Okay, now I've already got this applied to the chart, so I'm not going to apply it again, but find RMO Trade Model, okay, click Open, and that'll apply the Rahul Mohindar Oscilator as well as Swing Trade 2 and Swing Trade 3, as well as your exit signal, okay? Again, just to go through it one more time, right-click on an empty part of the chart, apply template, and find RMO trade model, basically. Okay, that should be all you need to do, Chris. Okay, so now we're going to cover, let's go ahead and get real kind of close up and personal with this chart. I'm just going to zoom in on the last day. And I'm going to cover basically, I'm just going to pretend that today we opened up this for the first time and we're looking at a position or trading this particular stock today, okay? So if the first thing I'd look at is step number one, our primary trend, okay? It's in a bullish zone, basically. So I know that I'm allowed to do a long position. Step two is I'd look at our short-term trend, which again was the pinkish indicator here. It's above zero, which means our bar is highlighted blue, which means we're still allowed to look for a long entry trade, okay? So how do we actually get in a trade? We know we have permission to buy according to this methodology. How do we structure a trade? For that, we're going to cover the third indicator here. And this is what we call the Swing Trade 3. Okay. Now this was long-term. This was short-term. The Swing Trade 2 was short-term. This is going to be kind of a medium-term indicator. And it measures that medium-term strength that we've been talking about, trend and strength and whether a stock's strong and weak all day. The middle one or the blue one basically measures if we're strong medium-term. And we're going to look at it a little bit differently than we've looked at the other two indicators. We're not going to use the medium-term indicator to determine whether or not we should get into it or whether or not medium-term is bullish or bearish. That's not really what we're concerned about. What we're going to do is we're going to look for the short-term to get stronger than the medium-term. In other words, right here, where the short-term indicator, and I'll change it back to a line, where it crosses up above, we show more strength short-term than we do medium-term. We would use that. Rahul calls this when he teaches his training online, and I'm going to show you where that's located. But he calls that a change of strength, okay? It just happened yesterday, okay? And it happened a few days before that. When that happens and all of our signals line up, we're going to basically do what we call, we're going to structure a trade, okay? So on natural gas today, there's not a valid trade, but we probably would have structured one yesterday. Okay, if we were looking at it yesterday. Okay, now if I come back here, there's this change of strength again. You see how it goes down below. And we get a sell signal on the chart. Basically, when that happens, we put a buy or a sell signal on the chart. If we were looking at this, basically, this was the 21st, we'd have a sell signal, but we would completely ignore that because we're in a bullish zone, both long-term. Okay, we're up above zero on our major RMO indicator, so we're in that bullish zone. And short-term, we're strong as well, so we're going to completely ignore that particular one. We're never going to trade against those trades. We're never going to trade against a trend anyway. So I'm just going to scroll back a few months, and again, now we're going to start talking about hypothetical trading. And all kinds of rules come into play when you actually start talking about hypothetical trading. Obviously, these are some issues that I've looked at. I'm going to show you some good trade examples. Generally speaking, with this one, I've pulled in some symbols that are ETFs. But again, if it's something that you're interested in, obviously these examples are going to play out pretty well because we've had some dramatic run-ups. But if it's something that you're interested in, play with and see how well you like. Okay. If it's something that you feel is going to help you make money, great. That's my goal. Okay. So I've scrolled back to actually, let's start with this one right here. Okay. We're looking at August basically 12th. Okay, we'll start with one that didn't make money. And on August 12th, we pull out, let's just say that for the sake of argument or for the sake of demonstration today, this was the first time we had pulled off. And it's always pretty easy to trade back historically. It gets a little bit more difficult when you don't have data over here. So again, play with it, see how you like it. So August 12th, we pull in here. We see a sell signal. Again, we're in a bullish zone, so we're going to ignore that, okay, until the next day. We come back into the ETF, and we see not only are we in a bearish zone now, we also have gotten weak, both long-term, so now we're in a bearish zone, and short-term. So we've got everything that we need to go ahead and structure a trade. We have the sell signal the day before, and now everything is showing a sign of weakness. Okay. Now we're going to structure a trade, and it's very important that we do this according to the way the Rahul teaches it. So here's what I'm going to do. I'm going to draw two vertical lines on this chart. I'm going to look at the day where I'm going to decide that I want to structure a trade. I'm going to look at the day before I want to structure a trade. I'm going to draw a horizontal line all the way across the chart below the lowest point of those 2 days. So since my low was right about here, what is that price? 1543. I'm going to put my line at about 1540. It's just 2-3 cents lower. Okay. Now I'm going to draw a second one. What I'm going to do is I'm going to look at the high of those 2 days. Okay. This one was 1572. The day before, the high was about 1574. I'll place my second horizontal line right above that price activity. Okay. Now here's what I'm going to say. Okay. If the price tomorrow or the day after that or the day after that drops below this horizontal line, I'm going to go ahead and place an order short. Okay. So here I'm going to basically, if it confirms that it's probably going to start moving down on us, I'm going to go ahead and put a short order here at 1540. Okay. And I'm going to get in just as close to 1540 as I can. If it gaps down below this, I talked to a lady on the phone after my last presentation, and she's like, well, don't quite understand because it gapped below that line. Should I go ahead and take the position? And I said, well, unless it gapped a long ways down below that line, I'd go ahead and still take the position. The reason if it gapped like down to, in this case, like 5 or 10, I would not go short. And the reason is your risk-reward ratio is just going to get a little bit out of whack. Because this other horizontal line that I've put on the chart, 1584, I'm going to say if it comes back up to that price point, I'm going to get out. So here I've got a pretty close to realistic expectation of what my entry price is going to be. I know that if this trade goes against me by 40 cents in this case, I'm going to get out of the trade. So that gives me a really good idea or a really good definition of what my risk is going to be. So 40 cents on a $15 stock, it's actually a pretty good risk-reward ratio. The next day, nothing happens because we don't go below 1540. The day after that, we get into a short position because the price goes down below that price. So we probably get filled right about 1540. It didn't gap or anything. And it looks like the next day, let me zoom in on this. Looks like the next day we probably would have stopped out for a 40-cent loss. Okay, so there you go. I started with a losing trade for our very first trade. And it's important to say that this system is not going to win every single time. Okay, but because we only lost 40 cents, we have the ability to wait and see if and play again another day. Okay. Several days later, Okay, we get a buy signal. However, I'm going to put a horizontal line. I'm not sure you guys can see my cursor or whatever. However, we're not going to take that long signal yet. Why not? Because we're in a bearish zone. This first trust ISC natural gas is weak. We're not going to buy into weakness, and we're not going to sell into strength. So we're going to ignore it. Okay. So the next day, okay, short term we go strong. We just go a little bit above 0, but again, we're still in a bearish zone down here. Okay. So we're not going to do anything today either. Okay. So the next day we come in, okay, and we have our buy signal. Our buy signal happened 2 days ago. That's fine. Now we're showing strength, and we're showing strength short-term and long-term as well. So now what we're going to do is we're going to go ahead and structure a trade. And we're going to do it exactly the same way we did it last time. We're going to look at this particular trade, or the day we're going to actually enter the position. We're going to look at the day before, and we're going to put a horizontal line right above the price activity there. Okay, and I'm going to do the same thing with the lows of the day. Here's where we're looking at getting in. Here's the day before. Our lowest price is right there. I'm going to put my horizontal line right below that price. Okay, so I've said if it goes, for any reason it goes above 15.97, okay, we're going to buy. If I buy this, and for whatever reason it drops down below 15.43, I'm going to sell. Okay? So again, I have a reasonable expectation that I'm either going to make money on this stock, or in this case, this ETF. I say stock a lot. I just mean instrument when I say stock. I'm going to have a good explanation that I'm either going to lose 50 cents or I'm going to make money. Okay? Around 50 cents. Again, if something gets a little gappy, it might gap down below your stop and you'll get a worse exit. So you never have a guarantee of a certain risk when you're trading in a market. But usually, you know, unless something happens like somebody accidentally sells $1 billion worth of stock instead of $1 million, you have a pretty good handle, except for those extreme circumstances where the market gets terribly illiquid. You'll have a good handle on risk. Okay, so a few days later, we go ahead and trigger into that trade. The price trades above that activity. And so we are in a long position. Pulls back a little bit, okay? And now we actually kind of start to get into a place where we're not doing anything, but we are making money, which is a good thing. Okay, so we're into this trade. It looks like we've gotten up to about a couple points up. This is the bar I'm going to kind of zero in on, okay? And we've gotten a couple points up, and we get a sell signal. When you get a sell signal on a chart and you're in a long position, you're going to do two things. Number one, you're going to check your major trend. And we're still in a bullish zone, okay? And if that's the case, we're going to ignore that sell signal, okay? If that was bearish, well, then we'd move on to step number 2, which is a short-term trend, okay? And if that was bearish as well, it's not. It's bullish in this case. We'd go ahead and exit out of that position, but it's not. So we're going to go ahead and keep fishing. Okay, let's move on a little bit more. So a couple days come back, and this ETF starts to go up. Let's go ahead and put a vertical. This is the bar I'm talking about right now. We get another buy signal. Now, I can't see your questions right now. I usually say, well, what do you think we do during this buy condition? Okay, obviously, here's a buy condition. We're already in a position. And I'll get a couple of different answers. People will say, well, we should buy more. Or people say we should move our stop. With this one, I try and teach Rahul's rules. And Rahul is very, very adamant about not buying more. In other words, this is a position where you'll either be long or you'll be short. And you'll be long the amount of your position that you want to trade the whole time. But he does want you to move up your stop right here. Okay? So right now we have a profit loss stop. Let's go ahead and move that stop up so that we can guarantee some money. We're going to move the stop up in exactly the same manner. So we're going to look at the low where we get that signal. We're going to look at the low for the day or the bar before. If you're looking at hourly bars, it doesn't matter. We're going to look at those two low activities. Okay? I'm going to go ahead and move my stop. I'm going to say now if it gets down below 17.18, I'll write that on the chart, 1718. Going to go ahead and sell out of that position. Okay. Here again, the same thing happens. I need to move a little quicker because I noticed I'm running out of time. Here we get a sell position. Okay, so we're going to ignore it again because we're still in a bullish zone. Okay. Here we get another buy signal, which means we're going to go ahead and lock in some more profit. So I'll put a condition right here to buy. 1836 is my new stop loss. And this is starting to feel pretty good. We're making some pretty significant gains on this particular stock. Here we get another sell signal, which we ignore. Here we get another buy condition, which we use as a reason to move up our stop. In this case, 1884. Let me put that on the chart too. 18.84. Okay. Here we move up our stop again. Okay, see, once you start in a position, as long as we're making money, we're going to go ahead and keep moving up our stop and keep moving up our loss. Okay, so here we get our last buy signal, the very end of the chart. This is the one we were looking at when we started. And again, we're going to just move up our stop, okay? So we'd technically still be in that position, and that's okay with me as long as we're still making money, which we would be, hypothetically. This position is, our new stop loss is 2017 or 2018, okay? 20.1776 is where I drew that line. So we'll round up to 18. There we go. And that's been a very, very successful trade. We got in at about 15. We've made just about as much money as we can off of that move, I'd say. Eventually, one of two things is going to happen to get us out of that particular trade. We're either going to go all bearish, and in that case, we'd want to get out of the position. But more likely, what's going to happen is we're going to move up our stop loss, and we're going to stop out for a gain on this particular stock. So we did lose 40 cents on this first trade that we did. And you will. When it moves sideways or when it starts to change direction, you will lose money. But as long as you have a nice established trend on a stock, which the RMO will help you identify where we're at in a trend and what you should be doing with it, this is a system that works really, really, really well. Okay.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.